Good afternoon. You're watching Business Plus. The US Federal Reserve on Wednesday decided to raise interest rates by 25 basis points, expressing caution about the recent banking crisis and indicating that hikes are nearing an end. The increase takes the benchmark federal fund rate to the target range between 4.75 to 5%. Now, along with its ninth hike since March of 2022, the Federal Open Market Committee, FOMC, noted that future increases are not assured and will depend largely on incoming data. Remember, a sharp increase in interest rates since last year has led to strains in the banking system. Two US banks, Silicon Valley and Signature Bank, collapsed this month, buckling in part due to problems caused by higher interest rates. Fed Chair Jerome Powell acknowledged the recent events in the banking system that likely resulted in tightening credit condition, and that was likely why central bank's tone has also softened as of today. I have with me Karthik joining us in the newsroom. Karthik, the US Central Bank has raised interest rates again despite fears that the move would fuel or could lead to further dampening turmoil in the US banking system.
Of course, I think it's a very tight rope that US Fed is also walking on, because look at both sides of the rope that they're walking on. On one side, you've got a brewing financial instability, a financial crisis, so to speak, while on the other side, you've got high inflation. So the last time I remember a 5% interest rate in the US was perhaps in 2007. And if you look at the scenario back then in 2007 and today when we are sitting in 2023, 15 years hence, they were dealing with a financial bubble building up. It was a subprime crisis then, and they were dealing with high inflation. The Fed kept increasing rates, as a result of which there was liquidity that got sucked out of the markets. At that time, it got invested in real estate, and then the subprime crisis sort of, that bubble went up and eventually bust, because the real value of the mortgage was not as high as what the bank's exposure to the real estate market was. So I fear it's a very tight rope that the US Fed is walking right now, and 5% is a fairly high interest rate. What really comes to mind is, and this is something in fact that I read this morning, Sanjeev Sanyal had also quoted, that is the responsibility of tackling inflation solely with the central bank in any government. Should US and thereby even other countries including India look at fiscal measures rather than monetary measures? I think that is what we should try to explore.
Okay, we will explore that. Suman Chaudhary, who is the Chief Analytical Officer of Equity Ratings, is joining us. I will come to you, Suman, in just a bit. But Karthik, Wednesday's rate hike is 9th in a row, and it lifts key interest rates, as I said, 4.75 to 5%, up from nearly 1% a year ago, the highest level since 2007. So, essentially what we were discussing this morning, it's a repeat of history for the US Fed, a choice between taming inflation and containing the crisis.
Absolutely. You're asking me or asking Suman?
I can begin with you and then move to Suman.
So exactly. So 2007 is when we saw this, and 2007, of course, financial instability for a different reason, the property bubble, the real estate subprime crisis that happened, and at the same time there was high inflation, 5% high interest rate. 15 years later, we are in the same situation, and we know what happened 1 year after 2007. 2008 was the big Lehman moment, the real Lehman Brothers crisis, and the entire meltdown of the system. Now, there have been talks and there have been speculations and data suggesting that the economic turmoil is not too far away. How much can the Fed keep doing to contain that and to really prevent that from happening? Because there's only this much runway that the Fed also has. What do you do beyond 5%? Maybe one more rate hike, maybe another 25 basis points. What beyond that?
Okay, it still remains a debate. Suman, I want you to come in there. What exactly can US Fed do? That is the question.
Well, I think it's a very difficult choice, honestly, for the Fed. They're working on a very, kind of a thin rope at this point in time. Already they had enough problems at their hand, when it was very sticky inflation, which is not coming down in a hurry. And as Karthik mentioned, rates, if you look at the last 1 year, since last April, May to now, the rates have virtually gone up by 5%. Effectively, the rates were near zero. And now it has kind of come to 5% in US. Now, that is the genesis of the whole, if you see the banking problem that we are also seeing, the very sharp rise in interest rates. So the point is they're already dealing with that, that they had to increase interest rates like this because of the sticky inflation. On another side, they have this banking issue now coming up, which is creating a problem, a crisis of confidence in a way in the banking system. Although I would say it is nowhere near the scale of what happened in the global financial crisis in 2008. This is much more, at this point, it seems it's much more manageable. The confidence to control it seems to be higher. And that is the reason the Fed didn't go for a pause. They decided that they will have to focus on controlling inflation. So they have again hiked the rates and kind of bringing it closer to 5%. But I think the question is that will this solve the problem, or is this kind of helping to stem inflation? Difficult to say. I think the medicine has to be taken. If you go by classical economic theory, monetary policy has to act, which is what the Fed is doing. But yes, the government also has to play a role. Fiscal, I agree that fiscal policy is also important. You see, the liquidity part is getting taken care of, so more quantitative tightening is happening. The government also has to spend less. There has to be less of money supply. All these factors have to work together. But this is, yes, there is a medicine, but is there a side effect? The answer is yes, there is also a side effect, because you risk kind of having a problem on retail loans because interest rates are going up so fast. The economy may slow down. So these are problems that the economy has to go through. So I see that it's not something that the Fed can do easily. It has to go the path of monetary tightening. But yes, there will be side effects, and I think the economy has to be prepared for that.
Okay. Karan is also joining us, Karan Maharshi, who's an economic commentator. I think point well taken, it's a bitter pill, but inflation numbers there suggest that inflation is not falling as rapidly as analysts would have expected despite consecutive rate hikes. So what exactly is happening as far as consumer prices is concerned? It's still 6% and higher than a year ago. So the consecutive hikes there not really helping tame inflation. Karan?
Yeah, hi, thanks for having me. So the primary problem pertains to core inflation, as I understand, and that excludes fuel and food. So therefore, I see two reasons for this problem. One, supply chain issues have been unable to meet pent-up demand post-COVID. And second, rising protectionism has restricted imports from countries such as China, resulting in the sourcing of goods and services from the domestic market within the U.S. This has stoked the inflationary tendencies, and they are becoming sticky at this point in time. And I think that is why consecutive rate hikes are not helping the problem.
Okay, thanks, Karan. Suman, help us understand, how does the balance between the monetary policy tightening and the federal policy, fiscal policy tightening work? Why is it that anytime inflation is seen to be sticky, come what may, the first port of call is always the central bank, and not enough is done on the fiscal side?
Yeah, I think, I wouldn't say, that things are not done. So if you look at, for example, in India, for example, if I take the case of India, today, one of the issues in inflation in India is food prices. And there has been the recent case of cereal prices going out of control and needs to be controlled. If you see the government on the fiscal side, some measures have been taken. Earlier steps were taken when oil seeds, edible oil prices had gone up, when pulses prices had gone up. There were some measures that had been taken, and I think the government on the fiscal side, those kind of measures to address the price rise, those will be taken. Whether they're enough to address the issue is another question. But definitely, fiscal policy, the right way to do this is to have a proper coordination between a monetary policy and fiscal policy. That goes without saying. Uh, the other point here is that you also have to recognize that these are very difficult times and these are unprecedented times. As Karan also mentioned, that we have gone through a very difficult and a prolonged pandemic, and where there was supply chain, what happened was unprecedented. So there was supply chain issues and supply chains broke down. So we have a real problem at hand where inflation is not really coming down, or it's coming down, but it's coming down very gradually. So these are not problems which can be solved, overnight. And the other issue I think we are all concerned about, and I think Karan will also agree, the risk of stagflation. What we say, that there is a kind of a slowdown in growth, but inflation is also not coming down in a hurry. So high inflation, low growth kind of regime, which is kind of a pretty dangerous scenario for the whole world. I think that's the risk that we should be cautious about.
So, Suman, if I can borrow your medicine analogy, is it fair to suggest that fiscal tightening is like having multivitamins? The results are not immediate; the results are prolonged. You sort of build that immunity against inflation with fiscal measures, whereas monetary measures are more SOS. You pop a pill and you hope some magic is going to relieve you of your pain immediately. Is that a fair analogy to take?
I think that's a pretty good analogy. Yes, fiscal measures are necessary, and actually, you should a good doctor will always give you the both things, right? They will give you the pills and they will give you some vitamins also to kind of make your body a little stronger. Yeah, I think that's a pretty
So
good
let's
analogy.
come back home now. Let's come back to India. We've seen that we are pretty much towing the line of the Fed. Every time there's a rate hike, we follow up with a rate hike of our own, and inflation continues to be sticky for us back home in India as well. How much should RBI also continue tightening the screws? Does it make sense for India to again follow the footsteps of the Fed Reserve and tighten maybe another 25 basis points or something? Because inflation is not going anywhere in India as well. It continues to be sticky.
Yeah. So I think at least in our opinion, the likelihood of RBI going for another 25 basis point hike is pretty high. There is obviously we have seen the example of Fed not willing to pause despite the kind of turbulence we are seeing in the banking sector there. So I think, given the numbers that we have already seen, inflation numbers in January and February, almost 6.5 average, which makes it, RBI's forecast was 5.7% for this quarter. It's definitely going to be above 6%. So, and 6% is the Lakshman Rekha, right, for inflation. So I think there is a strong case for 25 basis points hike, which will also happen. The question is, what will be the statement on or the kind of path going forward? Uh, so that's something that's not very clear. I think it will be, as they say, data driven. They will look at the data and decide, but at least I am not very sure that they will be so confident to kind of put forward a pause at this point in time. So
Right,
it will
Karan?
depend on the data. I think going forward, whatever actions. But 25 basis points to me looks given at this point in time in April.
Got it. Got it. Thanks, Suman. Karan, let me come to you. So, Suman had just mentioned stagflation and that being a real and present likely scenario in the US where there are high interest rates and slow economic growth. Do you think that is really something that the US is heading towards? And if it does happen, how does it percolate down to the rest of the world, including India, but not limited to India?
Well, the understanding here is that the US Fed is in a reputation management mode at this time. So, what that means is that the US Fed has realized that it was behind the curve when it came to assessing inflationary tendencies building in the economy over the previous 2 years. And now that the US Fed can no longer manage expectations as the headline and core CPI numbers continue to hover over the 6%. I mean, the target is around 2%, but they're hovering over 6%. The consensus is that it must give a recessionary shock to the economy. And there are really no alternatives here. So as things stand, given the sticky inflation and the solid job numbers, I think that the terminal rate in the US can actually be higher than the 5.1% consensus. As far as the Stackflation is concerned, I think that's the reason why they will continue to raise rates, irrespective of what is happening in the macroeconomy in terms of the banking crisis, and consumer confidence will eventually fall.
Okay. And Suman, if I can come to you, I understand it may not be a sector that you or data that you track very closely, but specifically again in the Indian context, we talked about fiscal measures. How much of that really will be in our control? We've seen oil prices have cooled off globally, but beyond that, monsoon is not expected to be great. And overall, we are living in an interdependent world where it's not just our problems we have to deal with, we've got to deal with problems of the rest of the world as well. So how much of this is actually in the realm of possibility to control from the India perspective?
I think in the kind of global environment that we live with, I guess a lot of it is not within our control. But if your example, Karthik, I will take on oil. I think one good thing that has happened is, as you may be aware, that India has the share of imports of oil. One of the reasons why our oil imports have become cheaper. One thing is, of course, the global prices have seen a moderation. But the other thing is that we are increasingly importing a higher share from Russia, right? Our basket has more Russian oil today, which is cheaper, which comes at a discount. I think that's also I attribute that to one of the as one of the successes of the government. So that's something that we are trying to do. But if oil prices tomorrow, because of any geopolitical issue, again goes up, I think that will not be under control. I think these are facts of life today, that there are a lot of global headwinds. But the Indian economy, the good news is that we are a domestic-driven economy. It's not export-driven like some of the other Southeast Asian economies. So we are not so impacted by global headwinds. We are, but not to that extent. I think that is an advantage that we have, and that makes us having the potential to grow at one of the largest rates, at a higher rate than some other big economies. I think that's where we are. But yes, we have our own problems. The first problem is the point that we're talking about inflation not coming down steadily. Food, some categories of food are giving a challenge. How we control that is going to be an issue. And I think the next part is, how do you really drive private sector investments? How do you, in this environment, how do you increase private sector capital expenditure? I think that's something that the government has to really work with the industry to make it going. There are many programs that, PLI programs that have been announced, but we'll have to see how it actually translates into investments on the ground. I think that is what is going to define our medium-term growth potential.
Okay.
Agree with you completely, Suman. Thanks so much, Suman.
All right, Suman, thanks very much for joining us. We're going to move